what is the difference between the two?
Yeah, I mean, it kind of the variable kind of, variable interest rates changes as the market changes. So it could go lower, it could go high. It changes in variances every single month, and it kind of depending on what the rate is of that today's market, it will go up and down based off that.
Yeah. So effectively, what's happening is the Reserve Bank sets the cash rate. And then that flows through to how much the banks need to pay in interest, or how much money that they receive for the deposits, and then so on. That flows through onto mortgages and interest rates, and also savings as well. So there's this concept, or all of the time, every single month, the RBA is making rate decisions, and then there's this big question about, are they going to pass on the rate rise or the rate cuts? And so in my experience, banks are really quick when interest rates go up to pass that on to the variable mortgages. When they go down, they sort of drag the chain a little bit in terms of discounting what they would be paying. And so where does that, if people are just paying more money in interest to the banks, where does that go? To the bank?
Yeah.
It just basically goes in their coffers,
Yeah.
and they get more profit, right? It's crazy. So that's the variable one. So it's going up and down. We're sort of just meeting the market. Talk to us about the fixed one. What's that?
Yeah, I mean, fixed is an agreed upon rate with the bank. Usually a term between 1 to 5 years, 5 years being the max, 1 being the minimum, on a agreed terms. So say 5%, you will only pay that bank 5% no matter what for the next 1 to 5 years, depending on how long you agreed for that term for.
Yeah, and that can look like a really good deal, right? Because you've got the certainty of it. You know what your repayments are going to be for that period of time. You've locked it in for 1 to 5 years. And if interest rates go up over and above what you've fixed at, you look like an absolute genius, right? Now, if they go the other way and they go down, then you've overpaid and you're stuck in that. But that's sort of the gamble that you've made with it, right? So what's the difference then between, if you can fix your rate for up to 5 years, what's the difference between the interest rate for, say, 1 year fixing it for compared to 5 years?
Yes, there is a variance to that. The banks usually will give you the terms of that, and you'll see that, when you see the banks offering their fixed rates for 1 year, it's dramatically much lower than what it is for fixed for 5 years.
Yeah.
It's usually about a 1 to 1.5 point difference.
And that's because they're taking more risk, right? They don't know what's going to happen over 5 years, so they have to factor that in. One really interesting concept, and people definitely don't understand this, is that all of the banks pay so much money to economists to forecast and predict what's going to happen with interest rates. And the reason why they do that is because they need to know on their fixed rates whether they're going to be up, down, or sideways. So if they think that rates are going to go up over the next 6 or 12 months, they've already factored in that to the fixed rate. And so you'll always see a fixed interest rate is higher than a variable interest rate because they've already factored that in. On the other side, the variable one, well, you're making the gamble whether it's going to go up or down. Let's talk about what other benefits there are, or what other takeaways there are off the back of, say, variable mortgage.
Yeah, so in terms of variable mortgage, it gives you much more versatility in terms of what you can actually do with that mortgage. The first thing being, you can restructure that mortgage with other banks, so it will allow you to refinance without breaking kind of like a contract with them and paying a significant fee to that.
Yep.
The second being obviously being able to make extra repayments into the loan, which is very beneficial to people that can and afford to pay the extra repayment and shave off a bunch of interest that way. So those are the main key points for variable.
Yeah, so that's a really big thing that I don't want to skip over, is that the key difference between them is with the fixed ones, you either can't pay extra repayments to it, or there's a maximum that you can do each year, which isn't very much, compared to the variable mortgage, which means that you can make extra payments to it. So if you sort out your finances, if you can put aside an extra $200 or $400 a week, then what that means is you're putting $10,000, $20,000, $30,000, $40,000 a year extra on the mortgage, which means you're paying it off faster. So it just goes to show it's another thing where sometimes you're so blinded by everything else, you're looking at specifically just one thing, which is that interest rate, and everything else just actually matters, which you're ignoring. Okay, so who are fixed rate mortgages more suitable for? Who are variable rate mortgages more suited for?
Yeah, so I guess fixed rates are suitable for situations where the client has a tight budget and they don't have actually a lot to spare after paying the mortgage and their expenses and their life expenses. This way they can kind of plan for the next 1 to 5 years, depending on how they fix it with a certain budget, knowing that they can't really go over that, and it can ignore the RBA going up or down.
Yeah, so just with that, like I remember I was working recently with a client and they had cut all of their expenses out because they had to, because their mortgage was taking up, we talk about 50%. I think their mortgage was taking up about 70% of their income. And so they were running on an absolute shoestring, and they couldn't take, if rates went up, it was going to knock them out. And so in that situation, they don't have the ability to make extra payments. So that wasn't really a consideration. And, they spoke with their broker and they spoke with us and they said, what's right under the circumstances? And the real big risk is that rates go up dramatically and they have to find an extra $1,000 a month. It just wasn't there in the budget. So that's where the fixed is suitable for those people. That's what you're saying, right? Let's talk about the variable one. Who's that more suited to?
Yeah, I mean, variable people who, variable interest rates really suit, people who have a comfortable understanding of if there is a spike or if there is a drop or whatever it is, in the worst case scenario, they can still afford to pay that, number one. And number two, where in their expenses and their budgeting, they have room to be able to save money and use that money to utilize to put into the mortgage to save interest and a lot of interest overall.
Yeah, awesome. So, it's not a one size fits all approach, but most people who I speak to, if they say fixed or variable, if they've got the ability to put some extra in, and what I mean by that is, stop wasting money on other stuff, reduce that down a little without sacrificing your lifestyle to create that surplus that you can put into the mortgage. Do that and have the variable one. I think over the long term, people get so fixated on this interest rate, but you can go and Google it, speak to ChatGPT, whatever. The fact is, when you're looking at 20, 30, 40 years of a mortgage, it's very minuscule, the difference in actual interest that you pay between fixed and variable. And that's because, and we keep saying it, trying to game the bank at their own game, you're not going to be able to do it. No. They've done all of the calculations at every level to figure out that this is going to be the thing that doesn't actually make any difference for them.